Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Constance Hunter with us, EIU right now. To really get started on the Fed decides, we'll do it at 1:30. Constance, I'm going to cut to the chase. There's actual growth, real GDP. You overlay that with inflation, and that's the present, the current, nominal GDP. The British say money GDP, which is even more confusing. I have two stories for Jerome Powell. I have nominal GDP, which is China-like, 5.4%, 6%, dare I say 7%. And I got a profession saying, no, that's not true. Which is it for Jerome Powell this afternoon?
So, yeah, the Atlanta Fed tracker certainly gave a boost to what the GDP could come in at. And we think that the inherent problems with trackers is that they don't adjust for what is coming. It's completely backward looking. It's a great tool, but 5% seems a little rich. Now, with that said, we had been looking for a softer growth pace for the fourth quarter, something a little under 1%, and we may need to end up revising that.
So
higher.
So revise higher. What do you think the Fed should do today? The market's saying it's going to hold. What do you think they should do? What do you think they should communicate to the market?
Yeah, so I think everybody sort of agrees they need to hold here. And I think what they need to communicate to the market is that they need to watch and wait and see how durable the price increases from tariffs are going to be. I think it is widely acknowledged that those price increases have not been put through. Firms held off passing those price increases through. For a myriad of reasons everybody is familiar with. One, we don't know if the tariffs are going to stay in place. IEEPA could be overturned. Two, tariffs have become increasingly unpopular. So if the IEEPA tariffs are overturned, it is unclear that the administration would even try to replace them fully through other mechanisms. So those are good reasons firms are holding back. However, we also know that households are going to be getting big tax refunds in the first quarter. And a bit in the second quarter. If you were a firm that hadn't yet passed on prices and were waiting to do so, this would be a great time to do it when households have a little more cash.
My theme today is it's not a snooze fest. John and I came up with that years ago, and hilarious back and forth with Frankfurt and the ECB. To me, there's almost a frenzy witnessed yesterday afternoon. As you mentioned, you got tariff uncertainty. We've got a president who day to day, tweet to tweet, we're not sure how bad he's going to go after Korea. I got gold doing what it's doing. I got foreign exchange screaming at me on weak dollar as well. For Jerome Powell today, is that backdrop of frenzy anything, or does he just ignore it? Well, how can he ignore it?
He can't. And I think your weak dollar point is exceptionally relevant, right? Because if we see the weak dollar continue through the rest of the year, we're going to have pass-through in terms of inflation from a weaker dollar. Less than other countries because so much gets transacted in dollars. But that is a risk. And then, of course, there's that concurrent risk that as people spend more on tariffs, what they do is they stop consuming other goods, right? And so it's a deadweight loss, as economists like to say. And it could end up slowing the economy. And that's why the EIU and many other forecasters think that there will likely be 2 cuts in the second half of the year when we've seen some of that pass through from tariffs come along.
Paul, I of the triangle here, it's Mundell way back at Columbia. But the answer is I'm looking at just what Constance Hunter said, which is the GDP rate of change into Q3, Q4.
Right. Huge uncertainty. When's the president going to select the Fed chair, and do we really care that much? Where are we on that process? Who do you think he should pick and will pick and all that kind of stuff?
Well, I mean, in the reality show, right? They want to keep us on the edge of our seats. So they don't want us to be able to game that. So otherwise, we won't keep watching.
Right.
So I can't say exactly when. I think he has to do it before the end of March. And of course, we have Senator Tillis, who's come out and said, I am not going to put through any, I'm not going to put through any nominations until you have resolved the issue with Lisa Cook, right? So, but look, everybody is talking about Rick Rieder.
Yep.
And then I heard it reported on Bloomberg News this morning that he has given some donations to Democrats, to other Republicans, Nikki Haley. I don't know if that disqualifies him in the president's eyes.
I can't even keep up. Constance is more up to speed than I am. Constance Hunter with us. Stay with us, Constance, with EIU this morning. Futures up 14. NASDAQ solid up 0.8%. The VIX fractionally 16.42 today. We're watching gold. Wow, Paul. Wow.
Yep.
5,300 an ounce.
Wow.
5.3
Yep.
up 3.7% on the currency complex that Constance and I are looking at. Here are the handles. 153 on yen, euro a 120 rounded up, 120 there, sterling a 138. Constance Hunter, EIU as well. So we got basically two stories here, and I don't fault the Fed for this. We've got a booming America, ASML over the Netherlands, beyond boom. I got a consumer flat on my back. Okay, Y equals C plus I plus G plus NX. Tell us about the consumer right now.
Well, if we look at the third quarter, the consumer was exceptionally strong, right? And as I mentioned, we are going to be getting these tax refunds in the first and second quarters.
So domestic private sales still say ample, solid, et cetera.
I think we're well within potential GDP range on consumption, certainly in the first half of the year. I think the issue is what we saw all been pointing to, which is that the corollary to higher gold is higher 10-year prices, 10-year yields. And if the goal of the Fed, and we'll go back to Rick Rieder, who has talked a lot about housing affordability, the mortgage price, how the tricky thing for anyone who becomes Fed chair and for the FOMC overall is how do you lower short-term rates and ensure that you don't have a rise in long-term rates amid all of the noise that is swirling around and the term premia that is elevated.
Paul, 486 in the 30-year bond, 14 beeps away. Are you and I on a 5% watch?
I guess we need to be.
I think we need to be, given dollar dynamics.
So inflation's still out there. If you talk to people on the street, that's the game. That's the story. And even President Trump is now, I guess, really leaning into this affordability issue, which really came to the fore with some of the elections in New Jersey and in Virginia. The candidates ran and won on the affordability issue. What is the inflation story out there?
Well, look, we're seeing elevated goods prices, where goods prices had been zero to slightly negative for quite some time because, of course, we have increased productivity in that sector of the economy. We obviously have China exporting disinflation or deflation to the rest of the world by their extraordinary supply that they provide. And the tariffs upended that. So something that was not contributing to higher inflation was actually contributing to lower inflation has gone away. And then, of course, services are hit with the labor shortage. And so we have increased prices for services, but also a lot of services use goods in providing their services, right? If you are a restaurant, it's a service, but you are using goods, some of which are imported to provide your service. So we are seeing sticky services prices as well. And so I think for the Fed, the trick is in the sticky services prices, how sticky are they? And how long is that going to be maintained?
Okay, so you're going back to price. I mean, here's Citigroup, Hollenhorst. He didn't get it today. Veronica Clark wrote this.
Yes.
Gisela Young is the one who actually wrote this for Hollenhorst. Citigroup just publishes, and they make clear the unemployment factor is what we should watch today within the medium. I have claims 200,000, 205,000. I'm sorry, that's a never cut rates ever again statistic. How do you interpret that at EIU?
Yeah, I mean, certainly the labor market is very tricky right now because it's what is sustaining employment? Is it 20,000 a month? Some people are saying it might be negative. Is it 40,000 a month? And I don't think we're going to get clarity on that right away. So you have to come up with some sort of average there. Let's say between 10 and 30,000 a month is going to be sustaining the unemployment rate. And then you have to look at the mix of jobs. A lot has been made of the fact that the sector that keeps adding jobs is healthcare and social assistance. Now, that makes sense because we have an aging population. It also makes sense because Americans purchase a lot of elective procedures, right?
Right.
And we actually saw an increase in consumption of medical services in the third quarter. So I'm not sure that is all bad, but it certainly tells you don't see growth in other areas of the economy.
So I guess just on the labor front here, is it still just the base headline unemployment number that the Fed is focusing on, or they try to really dig in and see the components, do you think?
Oh, I think they dig in and see the components. I mean, they have to look at unemployment. It's been a good barometer because they're looking at employment in relation to not just the growth rate, but how is that going to impact inflation, right? And so if people aren't looking for work for whatever reason and they're not participating in the labor force, that is something that the Fed needs to consider, which is why the unemployment rate is such a critical factor and an indicator for them to look at. It's really I would not want to be in that job right now. It's very tricky to balance. You have extreme countervailing forces. I was in Davos last week, and my write-up is juggling juxtaposition, right? We have the juxtaposition of the extreme benefits and boobiness of AI and technology.
I just figured it out. Did you write it at the Cloudflare piano bar? Did you write it?
I wrote it on the plane home.
Oh, so you say.
Yes.
Yeah. Barry was singing Sweet Caroline, Neil
right.
Diamond, and you wrote it at the Cloudflare bar.
Well,
Thank you.
You caught me.
Thank you so much for the EIU. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
So I'm all Cap M this morning, which is basically there's a rate out there, but beta is like the stock market movement, and there's a delta off expected returns. Stuart Kaiser's going, Tom, I don't care. We're just bullish. Is it just stimulus? Are people expecting out 6 months at Citigroup and saying up and away in our beautiful balloon?
Yeah, I think 100%, Tom. If I look back even to the fourth quarter of last year, one of the reasons we expected cyclicals to work to start 2026 was the feedback we were getting from clients about how much stimulus they expected to kind of hit the economy in the front half of this year, particularly via tax refunds. But just in general, there's a very bullish outlook for U.S. economic growth front half.
Paul Sweeney, Julian Emmanuel with his note this morning, and it's not 14% earnings growth. Right now he's modeling 18%.
Yeah,
18%.
Yeah, where's this coming from?
Are you kidding me?
Some margin improvement, that's for sure. Cyclicals, is it a trade? Is it rotation that we should be really paying attention to 6, 12, 18 months out?
I think 12 to 18 months out, probably a little too far. I think a lot of folks are thinking about this as a first half trade because you have the midterm elections and then potential inflationary impact in the second half. That's not our house view, but that is a conversation folks are having. So I think at least the front half of this year, which probably means you want to sell in about April, if everybody else is prepared to sell in June or July. So look, there is a sort of very positive momentum in the U.S. economy right now. I know there's nits to pick on that, but if you look at Atlanta GDP tracking, if you look at what's going on with the unemployment rate, the economy looks to be in good shape. Yep. And you throw on top of that some really strong tax refund data anticipated, and that cyclical trade we think has some legs here.
This is the busiest earnings week of the quarter here. What are you and your analysts at Citi seeing, and what do you expect to see?
Well, I think what we're seeing in terms of price action is that the tech stocks had kind of underperformed for a bit of time to start the year. And you've seen some early reports, GE Vernova, for instance, on the AI side, are just reminding people about how powerful this trend is. Yep. So I think what you've seen is if you were a little bit underweight or a little skeptical of these stocks to start the year, then you are clearly don't want to go into these earnings reports, kind of positioned that way. So, people are bullish and I think they should be. The bar is obviously very high for these earnings reports, though. So, if I remember correctly, I believe Meta was off, over 10% when they reported back in October. So this is not without risk, but I do think people were probably a little light in the tech space coming into this week.
Well, that's where I wanted to go. ASML in the Netherlands, a lithography, read the chip war. Chip Miller, Chris Miller. Chris Miller's Chip War was my book of the year a couple of years ago. It's absolutely fabulous. ASML has a 62% institutional ownership, like Apple has. And I looked at Kimberly-Clark, boring, with like an 85, 90% ownership as well. From where you sit on the Citigroup desk, Stuart Kaiser, are all these fancy stocks we're talking about, are they basically under-owned?
It's a great question. It'd be almost impossible to own enough of them. And just to give you a little feedback, like if I'm up in Boston, for instance, a lot of these benchmark mutual fund investors are not used to having this concentrated a portfolio, right? Because you're benchmarked to the index. And now you're sitting with 10% of your portfolio in one stock.
Does Will Danoff at Fidelity have a different rule book than everybody else? He just bought Meta and, I believe, held on to it.
Yeah, I mean, look, he obviously was comfortable with that kind of concentration risk, but I think some portfolio managers and investors just don't like having all of their kind of portfolio tied up in a very small number of stocks. So it has been a challenge. You didn't ask this question, but in terms of retail, what we're seeing, obviously they love tech, but they've actually been quite involved in the industrial sector over the course of the early 2026 as they kind of warm up a little to the power gen as well as aerospace and defense trade. So to your point, Tom, there are probably some of these stocks that are so large as a part of the benchmark that people don't want to be too overweight them because it just feels uncomfortable.
Yep, absolutely. ASML up 5% today, up 40% year to date. The stock has doubled over the last 12 months. Just another story. So again, we're going to get a lot of tech earnings here. I can't see a world where tech doesn't lead, though. I mean, it just feels like if tech is not working, the market might have a hard time, or have we moved out of that narrative?
There you go. There's the worry.
Well, the bottom line is if you take Mag 7 and you add in Broadcom, your quote-unquote elite 8, that's 40% of S&P 500 market cap.
Wow.
It is hard for a market to work if 40% of the market cap isn't working. So to your point, yes, it's like, A, you need the theme to work because everybody's invested in the theme, but B, just, I know it's too cold for math, but if four out of your $10 is in these stocks, you really need them to at least participate or be flat, right?
Is there a bet now expressed by margin or heavy use of options or futures? Is there a leveraged exuberance going on right now?
I think there is a little, Tom. If you look at like FINRA margin account balances, which is monthly data, the ratio of borrowing to credit in those accounts for retail investors is 3x and is by far the highest we've seen in the last 25 or 30 years. That said, it is actually a relatively small percent of market cap for the S&P.
Right.
So you're seeing people with leverage in their accounts, but those accounts have barely kept up with the market, basically.
Huge earnings day today. Carol and Tim leading with coverage this afternoon as well. Apple tomorrow. The foreign exchange, I was up basically all night on Europe. I mean, just extraordinary dynamics in foreign exchange. We're so advantaged to have Stuart Kaiser with Citigroup. The President of the United States, with all that's going on, talking to Saleha about neo-mercantilist theory and the rest of it, Paul?
Yep.
May I quote, "It is the same mindset that gave pro football the new and unwatchable, quote, sissy, unquote, kickoff rule that made it possible for Bill Belichick to not be elected into the Pro Football Hall of Fame. Both are ridiculous and should be overturned." Exclamation point. I can state without exception, there's never been a presidential tweet I've more agreed to with that. Good morning, Mr. President. We hope you're listening to Bloomberg, and we hope you'll listen to the Fed Decides this afternoon. I mean, Stuart, there it is, a president locked in on Bill Belichick.
And honestly, the worst part of this kickoff rule is you don't even have to fair catch it anymore.
I don't know. Yeah.
They just let it bounce.
I still don't get it.
I don't get it.
He's forcing to catch the ball, right?
Cy in the control room explained it to me once, and I was fortunate it was after the third martini. I don't get it as well. So it's a bull market. Do you have I get you're doing more of a trading thing. Folks, Stuart Kaiser's like the TV show Industry. It's like, he is like the guy in Jon Snow in Game of Thrones. He is the Jon Snow of trading. It's Citigroup. With that said, Stuart, do you have any vision past the 4th of July?
Not at this point, frankly. I would say a lot of people, as I mentioned earlier, said, hey, own cyclicals into the front half, and then in the second half, I run into this election risk, and it gets a little bit concerning. If you believe that, though, what is the single best way for the Republicans to defend the House? Is to have the economy humming, and is to have these tax refund dates go through. So I think a lot of folks are of the view that they are going to throw the kitchen sink at this U.S. economy in the front half and try to get it moving. And if you believe that, then you're trading the second half now, basically.
Okay, come back to our Stuart Kaiser. With lots of sidewalks outside.
Yeah,
when I came in, it was a little bit. a little bit sporting.
Seems like in years past we got rid of the snow a little quicker. I'm not sure.
Well, we've never seen, since I've been in New York City, we've never seen cold like this.
Yeah,
this
exactly.
Is
exactly.
CNN
not going
said
anywhere.
the reach of the country of this storm from New Mexico all the way over here is like 121 years.
Yeah. It's
or so.
Significant.
Grandpa Kaiser was trading off the Citigroup desk back then. Stuart Kaiser with Citigroup. Thank you so much. He's head of U.S. equity trading strategy. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We're going to slow down now, folks. To have Ira Jersey following up here is wonderful. And this is, you just flat out get lucky. We booked Dr. Thin for a conversation on the Fed and on the American economy, but we're going to rip all that up. Thank you, Constance Hunter, for giving us wonderful perspective there. And we're going to talk to Dr. Thin about all of his academics, the privilege of working with Robert Mundell, with Columbia, and with Georgetown as well, on what currency is saying to President Trump. I went back and I looked at log trade weighted.
Oh, boy.
And I looked at the Plaza Accord in the 80s. Now is a shadow of the Plaza Accord dynamics. It's not a time for another Plaza Accord, is it?
No, it's not. It's a very different world right now, Tom. First of all, I want to say thank you for the kind words. It's really my honor to be here with this great crew. Always love coming on and having a great discussion. So thank you.
I want to talk. Let's set this up because Paul's got a bunch of FX questions as well, probably more sane than mine. Mundell at Columbia dragged us into the modern era. Then Jacob Frenkel at Chicago, Rudy Dornbush up at MIT, on to Rogoff and the rest. Under Mundell, when he talks about a three-part dynamic, explain that in the modern age right now for President Trump.
Sure. First of all, Professor Mundell was a brilliant economist, and I think any international economist should read his works today. It's still, to me, groundbreaking. He introduced the whole idea of capital flows before capital flows actually.
Is Donald Trump aware of the capital flow risk when he says weak dollar?
Well, right now they're having this sort of in this little sweet spot where they're getting, they're getting a weaker dollar without the spillover into other markets. But we've seen time and time again in both developed and emerging markets. There are times when these moves get very disorderly, and it's hard to get that genie back in the bottle. So I'm sure Mr. Bessent, of course, who was there when they broke the pound back in the early 90s, is well aware of how capital flows can really impact markets. So Mr. Mundell back in the 50s and early 60s talked about capital flows when really cross-border capital flows were not really in vogue. They weren't really there. It was very much a home bias. Americans invested in America, Europeans invested in Europe. But he introduced this whole concept of the impossible trilemma, I think is what you're referring to, where it's impossible to have fixed exchange rates and maintain an independent monetary policy. And you can't, something's got to give. Bank of Japan had that problem a couple of years ago. But again, it's all about the capital flows. Daily FX turnover is close to $10 trillion. And that's all capital,
right?
Not trade flows.
Let's walk away from academics. Paul Sweeney with Win Thin of the Bank of Nassau.
What are some of the maybe unsuspecting or unwanted ramifications of a weaker dollar? Again, we're seeing, 96 handle on the DXY index. We were at 100 just a cup of coffee ago, as Tom would say. What should we look out for?
Sure. When we talk about FX moves, I think the markets and the officials always look not only levels, but also the pace. Mm-hmm. A lot of times when the pace is controlled and the level becomes not so important. But again, as we've seen, the pace can all of a sudden, fall out of bed when you least expect it. So, obviously, Mr. Trump is talking about making exports competitive, and that's been sort of their mantra about getting manufacturing back on shore. But the sort of the negative repercussions, obviously imports become more expensive, so that becomes, the inflation story gets a little more messy. And again, we talk about, well, if you're a foreign holder of U.S. Treasuries and you're getting, say, 4% on a 10-year, all of a sudden the dollar's depreciating 1%, 2%, 3% monthly. All of a sudden that yield is wiped out, and so you're going to start demanding foreign investors start demanding a higher yield. So that's, to me, the biggest channel that Mr. Besson really, again, should be well aware of and should be very, very careful where they tread.
Is there a level that you think, okay, we're comfortable here, but if we go below this area here, then we start to get problematic, maybe in the treasury market, in the refunding market, and things like that?
Yeah, again, I'd say it's more the pace.
Okay.
It's been so far pretty contained, except for sort of the taper tantrum back in April. We had that dollar just fell out of bed.
Right.
It's been pretty contained,
Yep.
but I get the sense it's something, it's something.
Right.
The one thing I'll just point out, the FX market is generally like sort of the leading indicators, the asset that really sort of that markets look to sort of get, hey, thumbs up, thumbs down on what a country is doing. So this is worth keeping an eye on.
Oh, come on. We saw jump condition yesterday. Win thin with us, folks. The Bank of Nassau. Thrilled to have him with us. Ira Jersey scheduled to be with us as well. This is a killer half hour for Global Wall Street. Good morning worldwide on YouTube. Subscribe to Bloomberg Podcast. That's the way Alexis Christophers listens to us each and every morning. Dr. Thin, I want to talk then about Paul's really wonderful questions about level. I'm looking at Swiss franc, which is basically the new gold standard, and I'm sorry, it's on a log basis convex. There's an accelerative tendency now to the Swiss franc where Donald Trump is telling the Swiss, you got to go to negative interest rates. You got to change the way you're doing. Baloney. They're not going to do it. They've been doing this since the 1500s. How does Switzerland react to Donald Trump's neo-mercantilism?
Well, it's first of all, I think they're sort of scratching heads because I think they were hit with something like 40% tariffs earlier this year, and on top of this, they're getting the strong currency. So it's tough to be a small, open economy. I think Mr. Carney hit the nail on the head when he talked about at Davos. He talked about the great powers are sort of imposing their will, and sort of the middle powers.
Okay,
What do they do? And they're trying to band
it
it together.
Then go to Mark Carney. Good morning to Canada. And he spoke about a variable geometry. What's the new geometry for you of what all this fancy foreign exchange talk means to our listeners and our viewers?
Well, I think you'll see more alliances being built. I think this is what Mr. Carney made the point. Alliances were built on certain interests. You might have an alliance with one country on certain topic, but with another on the other. It's sort of the middle countries, the middle powers realize that they are sort of caught in this big wave of this conflict between the superpowers. But the belief is that by banding together, they can kind of carve their own way and maximize their welfare, and realizing that the old order is gone. I think Mr. Carney said it best. He said, nostalgia is not a strategy. This old way is not coming back. We're in a new world order.
New world order, but it just feels like we spent 60, 70, 80 years building up this global economy. How do you turn that back? How do you turn the dial back?
Yeah, so a lot of these things, they change over time, right? We talk for hours about the dollar's role as reserve currency. That erodes over time. It's not going to happen overnight. People aren't going to go out and dump treasuries and dump the dollar, but you can kind of see things happen. I think there's been, really in the last maybe 10, 15 years, there have been inklings of the shift in the world order. We had China sort of reassert itself on the global stage. Russia's over there in Europe. So we've seen some cracks, but it feels like more of a rupture now. Again, I'm stealing Mr. Carney's words, but he said it very succinctly and eloquently.
James Baker, in everyone, you put a mic in front of him. Mm-hmm. We believe in a strong dollar policy. Do you look at President Trump's neo-mercantilism as a one-off, or is there a permanence here to a new mercantile America that gets us to 130 euro, 120 yen, buries the Southern Asia that you are expert on, Win Thin? What does it do to EM? Who knows? I'll ask Damien. But is this a one-off moment, or is there permanence to our neo-mercantilism?
Tom, it's too early to say, obviously, but my gut feeling is this is for now a one-off. I've been working in FX in over 30 years, and if you remember back in the early 90s, Treasury Secretary Lloyd Bentsen used FX as a cudgel. That was when they were trying to get Japan to open up the auto markets. They did get the Japanese to onshore some of the car production here. There's definitely some pros and cons, but anyway, ever since Lloyd Bentsen was replaced by Mr. Bob Rubin, it's been the mantra is a strong dollar is in the best interest of the U.S. And are we
going to hear that from Besson? I got to go here, but are we going to watch this? Paul.
We have not heard that.
Are we going to hear this from Chairman Besson?
I don't think we've heard it. Every Treasury Secretary until now has been very strong. So that's why I think this is sort of, to me, perhaps a bump and hiccup. Maybe I think it's. I think that to me, what's confusing for our trade partners is that we had such a change in policy so quickly.
Ira Jersey's handlers just said you got to get Ira in here. One quick question: are Posen and Orszag correct that we need to be aware of a resilient or even lifting inflation?
That is the $1 million question, and I know that the Fed is sitting at the table right now debating that, and we know there's a whole spectrum of views. Again, the tariffs are a complicated thing now. The weak dollar is going to add to the mix. There's so many, to me, sort of drivers and cross currents. My gut feeling is that inflation is sticky, but it's coming down.
If we're on for the Bank of Nassau the third week of March, or even is it the first week of March? It's up to Paul's schedule. Can we bring Ira Jersey with us?
Absolutely.
Thank you. Greatly appreciate that.
No hesitation.
Bank of Nassau this morning. Folks, that is such a privilege to have him with the academic heritage of American academics on foreign exchange. They have Dr. Thin of Columbia and Bank of Nassau, where this is a real treat. We go stronger now. Ira Jersey joins us. We're looking into the Fed meeting this afternoon. Ira, what will your team publish into and out of the Fed meeting? What is the angle, the cast you're taking?
Yeah, this is not about this meeting. This is about the next couple of meetings, and it winds up being a new cast of characters that are voting this time too. Remember, Tom, that in January they always switch who the voters are, and incrementally speaking, we have slightly more hawkish members who are actually voters now. So the chances of so the bar is just a little tiny bit higher for the Federal Reserve to cut. That being said, I think there is, at least among the governors, a willingness to cut interest rates if the economy were to worsen a little bit, particularly the labor market, right? So all of the labor market data we get over the next couple of months before the March meeting will be key to what actions the Fed might take then.
Are inflation-adjusted rates in the many spreads, are they indicating a new resilient inflation bet?
No, actually, if you look at inflation break-evens, you look at either swaps based on CPI or just the Treasury inflation protected securities market. All of those are saying that they think over the medium and longer term, inflation is going to just kind of hover a little bit above 2%, 2.5% in terms of CPI. And what that means is, generally speaking, the core PC deflator and even the headline PC deflator, which is the Fed's preferred measure of inflation, that tends to be 25 to 50 basis points lower than CPI. So if the market is correct, you could actually see even more interest rate cuts this year. And this is something we published a couple of weeks ago, noting that the inflation market is currently saying, hey, we could have sub 2% CPI prints year on year in a year's time, and that suggests to us that maybe the Federal Reserve would be more than happy to cut another 75 to 100 basis points.
Ira, we were just talking with Dr. Winthin about the weak U.S. dollar. Historically, how has the Fed dealt with changes in the dollars as it thinks about its policy?
So the Fed chair will always tell you during its semi-annual, we used to call it Humphrey Hawkins, but the semi-annual monetary policy testimony, that the dollar is the purview of the Treasury Department. And while that's correct, the Federal Reserve in its deliberations and as it thinks about how the dollar might affect inflation, that will affect the path of monetary policy. I mean, ironically, a weaker dollar usually means higher price in dollar terms of imported goods. But at the same time, there is some margin pressure, I think, that will be brought on by this weaker dollar, where people aren't going to want to raise their prices as much as they might want to otherwise in this weaker dollar environment. And it will help the balance of trade, right? So a weaker dollar is going to likely help the trade balance generally. In terms of what goods are being imported and the prices of those goods. There will be substitution effects, and all of these things will go into the consumer thinking about the dollar and therefore how inflationary that dollar move can be, which I think is not going to be particularly strong. You wind up with incrementally on goods just a 0.5% or something like that.
This is like an Ira Jersey dominant constant conversation at Credit Suisse. Mm-hmm. Like 15, Ira was younger.
Yeah, he was younger back then.
15 years ago. I mean, Ira synthesized this for just the basic thing of Paul Sweeney's looking at the mortgage rate, or someone's looking at a 5-year CD. I mean, right now, the news flow tells me wait and look for an incrementally higher yield on a CD or let's go because the mortgage rates are going up. That's simplistic. How do you look at that?
Yeah, well, the mortgage rate is going to be based a little bit more on the 10-year than the 5-year. And we still have a modestly steepening yield curve. So the difference between longer-term maturity rates are going higher versus shorter maturity rates. So when you mentioned, the 5-year CD, the 5-year recently has kind of been the pivot point between, what the Fed's doing and also what people are worried about with either more supply and certainly demand for longer-term U.S. assets because of some of the trade deals and the tariff angst. Ultimately, I think now's fine if you want to, think about, locking in those 5-year rates, because I do think that ultimately the Federal Reserve is going to cut rates a little bit more, and certainly it's not going to be hiking, right? The chances of the Fed hiking over the next, year to 18 months is near zero, and the market is still pricing another 40 basis points or so of interest rate cuts, even though I think it'll probably be a little bit more than that. So you might as well lock in now. The issue with the long end of the yield curve is you do have different dynamics, both in terms of supply and demand. And next week we'll probably talk about this, but we have next week the quarterly refunding announcement. The Trump administration could actually start issuing less 10-year notes and 30-year bonds starting in February, and that's not being priced into the market right now, but that is I think known risk they have to look out for.
Ira, thank you so much. Ira Jersey with us with Bloomberg Intelligence and WinThin before that Bank of Nassau. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Saleha Mohsin joins us now. We're thrilled to have her on. Way too early. She's rocking 9 a.m.
Yeah, who needs
10 a.m. She's an author.
Yeah, exactly.
Sliding in. Her book, Paper Soldiers, really, really outstanding on the Treasury. She is our wonderful fiscal and Treasury reporter in Washington. Saleha, I really want to focus on Secretary Bessent after the comments by the president last night. The president clearly has a zero-sum neo-mercantilist strategy out there. All of our listeners worldwide of Global Wall Street want to know how the Secretary of Treasury will advise the president on strong and weak dollar policy. What do you listen for in the coming days?
Look, we currently have a Treasury Secretary who has a lot of experience in currency markets and currency policy because he worked for Soros when George Soros made the bet in the early 90s that broke the pound famously. So he was part of that team and has had some moments with the Japanese yen as well. So he's deeply knowledgeable about what's going on. Of course, when you're a Treasury Secretary, you're looking at it from a very different perspective, not a money-making perspective, but from an economic policy and national and economic security perspective. Now, the words that we heard from President Trump last night, to me, it sounds like he's already been briefed by the Treasury Secretary on the dollar's decline. Sometimes policymakers, even presidents, historically have not always known just how powerful their words can be on the dollar. And so we saw that immediate slump. So I almost wonder, are we going to see maybe not a mop up or a cleanup, but just a clarification with more nuanced statements on the dollar?
So, Saleha, we have a surveillance tradition here. You're out on YouTube worldwide right now. What's the name of the cat that's behind you? Is that Janet Yellen the cat? What's the name of the cat behind you right now?
That's actually just a very small dog named Laddu who wants to go live, apparently.
Okay, that's good. Going live with the dog. Saleha, I look at this and I got to go back to Swiss franc and the gold complex here. With all your contacts in Washington, is there any pulse to understanding in the chart I put out today? We're at 2 standard deviations, long-term gold trend up. 3 standard deviations is 7,400 an ounce. And I'm looking at a Swiss franc chart back to my childhood, Saleha, and we're basically near record strength Swiss franc. How does the Treasury Department and the White House react to that, or is it invisible to them?
It's not invisible. They monitor all of these same charts and data points, Tom, that you're looking at right now, especially on the Bloomberg terminal. They're looking at everything. But, we have a different administration. We're in a different era. We're no longer pushing globalism and free trade. We are raising borders since 2017, including through the Biden administration and back to Trump. We're seeing more isolationist policies. And if there is a benefit to a weaker dollar, then this administration will try to gain and get as much from that benefit. What we're watching for is any kind of disorderly movement in the dollar. If that slide down becomes disorderly, unexpected, unpredictable, don't know what's going on, we'll see some different statements.
Across the nation this morning, Saleha Mohsin with us. Look for her book. I'll put it out on Twitter and LinkedIn here. It's a fabulous summary of tension at the Treasury. Paul, are we giving a blue ribbon today to the beast behind Saleha?
I think so, absolutely.
I mean, we're talking, this is like, I feel like I'm at the Westminster Dog Show, Saleha. Paul Sweeney with Saleha Mohsin.
Saleha, this will be the last Fed meeting for Fed Chairman Jay Powell here. Give us a sense of what the White House is thinking about as they think about a new Fed chair.
Yeah, the White House has a big decision to make. President Trump has a big decision to make. We have 4 candidates, finalists so far. You never know with Trump when he pulls a new candidate out of dark.
What's the inside story? Stop. You know everyone. What's the inside story, Saleha?
Fortunately, we have published everything I could possibly know about this. I'm waiting to gather more information. It looks like as of a week ago, Rick Reeder of BlackRock was gaining traction. His interview went really, really well. Trump liked his comments on reform at the Federal Reserve. But, there's a wild dynamic here where Powell's saying he's not going to leave and vacate a seat.
Right.
And we had this DOJ investigation that it seems like no one at the White House really wanted. And then Senator Tillis, a Republican, who's saying, I'm going to block any Fed chair nominee until this investigation is resolved. So I almost wonder if an announcement might be a little bit further out, because looking at the Senate calendar, for anyone who needs confirmation, that name does not need to be presented to the Senate for another month.
What's the sense of timing here? I mean, here, for those of us on Global Wall Street, we're like, what's the president waiting for? Let's get going here on a selection.
He doesn't, like I said, he doesn't really need to pick anyone until end of February to make sure that slot is filled by May when Powell's term is up. It feels like it's been a long time for the rest of us because he's been doing this apprentice style, talking about this since June of last year, who he's going to pick, saying, I've picked someone, and in a couple of days, I'm going to announce it. And every time he says that, I tell you, Tom and Paul, me and our colleagues, Anne-Marie Horder and Josh Wingrove and Nancy Cook and Josh Green, we all just start calling sources and sort of preparing for an announcement. And now we're almost in February.
In your wonderful book, Paper Soldiers on the Weaponization of the Dollar, or this on the Treasury, Chapter 5, Saleha, the bad dollar. Does President Trump look at the dollar as a bad dollar and must drive it weaker to boost Boeing exports?
In the first term, I covered him very closely, and there was closed door discussion, which we reported at Bloomberg, about a dollar intervention in order to make it weaker. This time, you heard the president say that the dollar is seeking its own level, and that shows that his knowledge of currency markets and currency policy is much more sophisticated. He does not actively want to push the dollar down, but he definitely is enjoying the wins. Now, that is so far. You never know when things change.
Saleha Mohsin, thank you so much for driving all of our Treasury coverage at Bloomberg. Again, I'll get Paper Soldiers out on LinkedIn and at Twitter, winning all sorts of awards within economics in the last 24 months.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.